All right, welcome to this explainer on Driven Brands Q2 2026 earnings. Today, we're unpacking a really fascinating paradox. Think about this. How does a massive automotive player with over 4,300 locations deliver excellent top-line revenue growth, but at the exact same time, absolutely struggle on the bottom line? Well, we're going to look under the hood and find out.
So, here is our roadmap for today. We're going to start with the Q2 paradox, followed by the green flags and red flags, basically the bull and bear cases. Then we'll do a segment breakdown and finally look at their guidance and outlook for the rest of the year. Let's get right into it. Section 1. The Q2 paradox. Top-line resilience meets bottom-line drag.
Okay, the core conflict of this quarter is literally a perfect mirror image, though definitely not in a good way. On one hand, revenue steadily rose by 7% to a solid $507.4 million, and that was fueled by a 5% bump in system-wide sales. But then, on the flip side, overall profitability, specifically adjusted EBITDA, which measures their core operating profit, dropped by the exact same 7% down to $107 million. Now, you might be wondering, how does that even happen? Seeing a company execute so well on driving sales while simultaneously taking a heavy hit on profit is exactly why we need to dig much deeper into these numbers today.
Section 2. Green flags, growth, and debt. The bull case for Driven Brands.
So, if you're looking for the bull case, the operational drivers are definitely flashing green. We actually have 7 specific green flags here. On the growth front, there's that 7% revenue jump and 5% system-wide sales increase, which pushed total sales across their whole system to an impressive $1.63 billion. And the absolute star of the show, Take 5, posting a very healthy 3.6% same-store sales growth. From a financial health perspective, management's aggressive debt reduction is working smoothly, dropping their net leverage down to 3.1x. Add in the franchise brand segment, which is basically operating as this high-margin cash cow at an incredible 59% margin, and you've got a robust free cash flow expectation of up to $145 million for the full year. But the most crucial metric for understanding their competitive advantage is this number right here, 24. Take 5 just delivered its 24th consecutive quarter of positive same-store sales growth. Talk about an economic moat, right? That streak proves the massive competitive advantage of its stay-in-your-car, 10-minute oil change model. They opened 50 net new locations this quarter alone, and with AI-driven camera tech being deployed right now to manage real-time lines and maximize their throughput, this non-discretionary segment is an absolute growth engine. Consumers just keep coming back regardless of what the broader economy is doing.
Another massive green flag is the balance sheet. Management aggressively dropped the net leverage ratio down to 3.1x. That's a huge improvement from 3.8x just last year. To put that into perspective, leverage is essentially their debt burden relative to their earnings. This drop matters immensely because hitting their 3.0x year-end target means far less cash being burned on debt interest. In fact, their interest expenses were already down over $10 million this quarter. Lower debt simply means more free cash flow available to reinvest into expanding the actual business.
Let's pivot to Section 3, red flags, margins and macro, the bear case and restatement costs. Of course, we can't ignore the bear case. We have 7 glaring red flags that perfectly explain that 7% profit drop. First off, the accounting headaches. They took a brutal $11.8 million hit in Q2 for restatement costs alone, and they expect those fees to hit the high end of their $45 million range for the full year. Ouch. Second, there are serious structural leaks. Corporate overhead expenses widened to a staggering $52.5 million loss, and the Auto Gloss Now segment is operating at a shockingly low 4.8% margin. When you combine this kind of margin pressure with broader macroeconomic weakness affecting lower-income consumers, management was basically forced to guide full-year earnings to the absolute low end of their estimates.
Now, what's genuinely fascinating here is the narrative tension. Management frequently touts their highly resilient, needs-based portfolio, right? Yet, in the very same breath, they explicitly cited continued uncertainty with lower-income consumers as the primary reason for lowering their guidance. As the CEO pointedly noted, resilient does not mean impervious. Actually, scratch that. It means consumer pullback in discretionary, higher-ticket brands, like Mako, remains a very real storm cloud over the bottom line. It really challenges the idea that this business is entirely bulletproof.
Moving to Section 4, segment breakdown. Let's analyze Take 5, franchise brands, and Auto Glass Now.
When we look under the hood at the individual brands, the disparity across segments is just wild. Take 5 is the undisputed heavyweight here, generating $334.8 million in revenue and nearly $115 million in operating profit. Then you have franchise brands, which includes names you probably know, like Meineke and CarStar. This segment acts as an incredibly efficient, asset-light cash flow anchor, pulling in $41.2 million in profit on just $69.6 million in revenue. But then, look at Auto Glass Now. It generated more revenue than the entire franchise segment, yet yielded a meager $3.5 million in profit.
Visualizing these profit margins side by side makes the structural problem crystal clear. Franchise Brands sits at a phenomenal 59.2% and Take 5 at a highly profitable 34.3%. Meanwhile, Auto Glass Now's paltry 4.8% margin is acting like a massive anchor dragging down the entire consolidated company. Even though Auto Glass saw a slight 2.6% bump in same-store sales, its underlying unit economics just aren't pulling their weight right now. It is heavily masking the impressive performance of those other two segments.
Finally, Section 5, FY26 Guidance and Outlook. Navigating the second half of 2026. So management's guidance tells a story of top-line stability, but serious bottom-line caution. Revenue guidance is safely intact at around $2 billion, which means their volume and pricing power are holding up just fine. Same-store sales and robust free cash flow generation are also holding incredibly steady. However, because of the maximum pain from those one-time restatement fees, plus a pretty shaky consumer macro environment, management is essentially battened down the hatches. They've pinned their adjusted EBITDA expectations to the very bottom of their $430 to $460 million range.
As we wrap up this explainer, I want to leave you with a critical question to chew on. Considering that sub 5% margin, what specific operational levers can Driven Brands actually pull to fix Auto Glass Now, and exactly how long will the market wait for that turnaround? Furthermore, if the consumer environment continues to sour, will franchisee appetite to open new Take 5 locations finally hit a wall? Look, Driven Brands has built a powerful cash machine with a clear competitive moat. But fixing the leaks in the hall is going to be the ultimate test for this management team. Keep a close eye on those margins next quarter. Thanks for joining us.